Okay, good afternoon, everybody, and wishing you all a happy new year. Thank you for joining us today in what is our first webinar of a year, a jam-packed year for us. We have got a great lineup of insights, webinars, useful information across tax, financial advice, legal and accountancy to run out this year. But the first webinar of the year, what we thought would be great is to go through some top tax and financial resolutions. So I'm delighted to be joined by my expert panel and trusted colleagues, Chris and Henry, whom you'll be hearing from later on in today's session, giving you their words of wisdom across taxation and financial advice. Today's webinar, we're hoping to last for around 40 minutes and allow for 5 minutes of questions towards the end of today's webinar. So if you do have some pressing questions, then you can indeed put them in the chat function, which you'll see as always provided, and we will get to those towards the end. But as always, if you can, if there are any personal questions, then we'll be offering a free consultation, a joined up consultation across tax and financial advice this year. Today's webinar is brought to you by my company. My company is called the Fusion Consulting Group. A lot of you know me as Mitch the Taxman, but behind that is the corporate group called Fusion. And the idea of Fusion is to provide 360-degree advice for a private client and entrepreneur, so that rather than siloing along a piece of taxation advice, and the tax advisor would then have to explain it to the lawyer or financial advisor, we've got all those services in-house, providing a joined up, smooth, streamlined approach to professional advice. So I've introduced my colleagues, and my name is Mitch Young, and you'll see my details on there. And if you would like to follow me on social media, it's Mitch the Taxman. I'm joined by my senior tax advisor, Henry Smith Langridge, and financial advisor, Chris Wilding. You'll have all their contact details on the screen as well. And if you'd like the free consultation, just get in touch with any of us. So today's agenda, we're going to be, Henry will be speaking to you about the new allowances that are coming in, things to take advantage of before the end of the tax year, and to set some good tax tips, resolutions in there for you. We'll then move on to Chris, who will go over the financial advice, things to do before the end of the tax year as well as the usual allowances and things to do on that front. And then I'll finish up talking about tax planning, structuring, a few ideas that potentially you can stick to or consider as part of your financial strategy. Just so you know, the webinar is being recorded, so anyone who's registered will receive a replay email of that, and we are streaming live across social media channels as well today. I'm now going to pass you over to Henry, who will conduct the first part of today's presentation.
Thank you, Mitch, and thank you for the very lovely introduction. So I'm Henry. I'm the Senior Tax Advisor here at Fusion. I work in the tax department here, and it's a pleasure to be on this panel. I think we have a fantastic opportunity before the end of the tax year. So in the UK, our tax year ends on the 5th of April each year, which gives us a golden window of opportunity when looking at your tax planning affairs. So if it were after Christmas, you had some conversations with family members, or you're starting to review your personal finances, it gives us a nice 3-month period whereby we can review any reliefs available to you and making sure that you're paying the lowest tax bill possible, and that is legally possible to do. So, of course, when we see a a lot of our clients who come to us in this time of year, they always have questions in relation to forward tax planning, but of course there is still this current tax year to consider. So we'll run through some points in my presentation, but just to be aware, the tax year ends the 5th of April 2023. So when I refer to this tax year, I'm referring to the one that we're in at the moment. So first things first on the agenda, capital gains tax. So this is quite I would say it's a tax you don't see too often in the news, and I think it's probably one of the most underappreciated aspects of our tax system. So capital gains tax, every year, if you are a UK taxpayer and resident, you do get an annual exemption. It's called an annual exemption, which just offsets a bit of capital gains that are subject to tax in the year. So for the current tax year, it's approximately £12,300, and every year you get a new annual exemption. Unfortunately, that's where the good news ends. The next year, so from the 6th of April, capital gains tax annual exemptions are being reduced to £6,000, and then again the following year, 2024, it's going down to £3,000. So what does that mean for you? It means that the amount you sell will determine your capital gains tax liability for the year, and given the reduced amount of annual exemption allowable, it means that you're going to likely be paying more capital gains tax in the future. And what's important here is that this is a use it or lose it exemption. So if you are coming to the end of the tax year, maybe you hold some stock, maybe you hold some crypto, if you want to sell to realize some of those gains, this is a very tax efficient way of planning so that you can draw down on some of your investments and sell it in a tax-free, tax efficient environment. So say, for example, you want to realize a £12,000 gain before the end of the year, then you won't pay any capital gains tax on that as it's below the annual exemption. Of course, going forward, £6,000, it means that the amount you can realize each tax year is going down. So it just means it's going to be an increased tax bill for some people, or at least it mitigates the amount of tax planning we can do when looking at these reliefs available. So next on the agenda, capital gains tax planning for next year. So we got a few things to consider. So I mentioned stocks and I mentioned crypto, but other things as well. If you are looking to gift properties, if you want to give your the second home you own, or maybe you are approaching retirement and you're starting to think about gifting assets, there is going to be a capital gains tax exposure there. So when looking at gifting property, the deemed value of that for capital gains tax purposes, there is a deemed value for the market value of the property at the date of gift. So there may be a subsequent capital gains tax charge. If you're sitting on a property that has, say, £20,000 gain sitting on it, you sell it, you can realize £12,000 tax free, and then the rest may be subject to capital gains tax. So it's a nice time of year to maybe start thinking about what you want, what maybe you have intentions of moving some property over to your maybe perhaps children or siblings, and you want to do in a tax efficient environment, then of course give us a call. We will be able to advise you on that. But it's very important to note that this is a reducing amount each year. So of course, the faster you act now, then hopefully the more capital gains tax we may be able to benefit you with. Similarly, inheritance tax is another thing. Again, a lot of these taxes work in tandem with each other. So here at Fusion, when we look at your affairs, we don't just silo and look at the capital gains tax. We will consider every single tax you can think of and that is applicable to the transaction. So I mentioned earlier, gifting property. Of course, inheritance tax is also a key consideration for some people. In short, the principle behind inheritance tax is that the more long-term you're thinking and the more long-term you have, i.e. the more time you have now to gift before your ultimate death, it gives you plenty of opportunities to plan and to give assets away from your estate to mitigate your inheritance tax liability. As inheritance tax is probably one of the least liked tax of them all, if you could say that, if any were liked to begin with. But from an inheritance tax point of view, it's important and imperative that each year I mentioned here annual exempt amount. So this is not to be confused with that 12,000 figure I mentioned earlier with capital gains tax, but from an annual exemption point. So it's called the annual exempt amount for inheritance tax. It's a fixed amount each year you can give to anyone you like. So it could be your children, grandchildren, friends, family. You can give up to £3,000 each tax year. And so when you make a gift for tax purposes, if you survive 7 years, great, no further inheritance tax to pay. If you die within 7 years of making a gift, more than £3,000, then unfortunately there may be some inheritance tax. However, there are things such as nil rate bands which need to be considered. But for this purpose, we recommend each year, if you say have some money lying around that you want to give in an inheritance tax efficient environment, then I would suggest that you look to make this £3,000. So it's each tax year, and that's across the board for all of the gifts you make. If you can afford it, and if it's within your budget, we recommend each tax year to make sure you're giving this £3,000 away to anyone you like, so that your estate is lowering and your subsequent exposure to inheritance tax is less. Again, it's sort of a use it or lose it. You can only carry forward your annual exemption 1 year. So the maximum amount of gifts you can give free of inheritance tax is £6,000. So you can only do it 1 year. So say if you didn't use last year's, so we're in the 22-23 tax year at the moment. If you didn't use 21-22's annual exemption, then you can double up and give away £6,000 this tax year in that example. So inheritance tax, of course, it's all retrospective. So sometimes there could be complications when looking at inheritance tax. And of course, as well, no one knows ultimately when they're going to pass away. So gifting with this 7-year window that I mentioned earlier is incredibly difficult because of course, no one knows really how long they have left, which sounds a bit morbid, but of course, tax and death are two certainties in life. So when looking at the inheritance tax liability, the more you give, and just to emphasize my earlier point, the more you give sooner, the better it is from an inheritance tax point of view, because if you survive, and I've got the sort of schedule here, 3 to 4 years, it slowly tapers off to eventually at the bottom there, 0% after 7 years. So your inheritance tax liability for the first 3 years is its greatest, but if you gifted something 7 years ago, there's no inheritance tax to pay if you died. If you gave, say, money to your children and you died within 4 to 5 tax years, then your inheritance tax is less than that headline 40%, which you may have heard in the news, but certainly it's still tax that can be avoided if you survive for a longer period prior to the gift. So even if you're gifting property and you don't know who you want to give it to, so I mentioned earlier, every year you want to make sure you're gifting money so that your estate for inheritance tax purposes is less, i.e. the value of your total net worth is less for tax purposes. There's options you can use, such as trusts. So for instance, say you don't have children or you don't have grandchildren, but you want to make sure that there is provisions for them. You can set up trusts for, say, the benefit of your children, and then when your grandchildren come along, you can include them as a class of beneficiaries. So say you don't even need to necessarily have a clear idea of who it is ultimately that's getting your money, as long as there is a structure in place that allows you to give money. And for tax purposes, a trust is not included in most cases, it's not included in your estate. So it's a very tax efficient way of gifting money. So maybe 3,000. Of course, when we start talking about trusts, things can get more complicated. But as I say, if you can reach out to us, we'll be able to give you the best advice and tailor our advice based on your circumstances. But of course, the great thing about trusts is that they're very flexible. You can control the money. Say if you are worried about having your money, maybe you don't, perhaps maybe your children are under the age of 18, you don't necessarily want to give them money just yet, then of course this is a great way of doing it and ensuring that you're using your allowances earlier and making sure that you're not waiting until they're turning 18 to give them gifts. You're doing it at an early stage and in a sort of step-by-step process by slowly drip feeding the trust with cash from your taxable estate. Again, dividend allowance is another, similar to capital gains tax in a way. This is another reducing benefit that taxpayers are going to be receiving going forward. So for the current tax year, you can receive £2,000 of dividends, provided you're UK resident. You can receive £2,000 every year tax-free. Going forward, next year from the 6th of April, this is going into £1,000 and then subsequently £500. So our recommendation is to make sure that if you get to the 5th of April and you maybe haven't, say you have a limited company you're a shareholder of, and you haven't made use of your dividend allowance for the year, that hopefully before the 5th of April, we would tell you to make sure that you are fully utilizing your rates. And this is a fantastic one that is unfortunately on its way out, it seems. I don't know if the Chancellor is going to reduce this to less than £500, but at the moment, if you could take £2,000 out of your company tax-free, then of course, that's absolutely something that is very efficient from a tax perspective. And again, next year, if you keep waiting to draw money out of your company, as I say, this is a use it or lose it. So if you don't use your dividend allowance for the year, there's no possibility to use it again in the future. So there's a lot of things when thinking about tax planning, there are things we can do now, and there's things that we can do later. And this is definitely something to do now before the end of the tax year. As well, maybe some of you have heard in the news, there's been some substantial tax raises in the news, particularly for high earners as a result of this double dip recession based on COVID and high inflation. So we are unfortunately seeing the results of that in our tax code, and we're seeing that taxes are on the way up. And especially if you are a high earner, someone earning over £100,000 a year, you're going to see your tax bill most likely increase quite drastically in the coming years. But one thing to note is that from next year, your additional rate band for tax purposes is going down from £150,000 to £140 per tax year. So unfortunately, what that means is that the point at which you start paying the top marginal rate tax, which is 45%, is decreasing, which means more people will be paying it. And as my colleague Chris will talk about earlier, there's things you can do to mitigate your tax bill. But unfortunately, if you are a higher earner, it does mean your tax bill will go up. But that's not to say there are things you can't do to reduce that tax liability in accordance. So immediately, if you're earning £150,000 a year, you're going to see a bill increase roughly of about £1,200. That's doing nothing. Of course, that's not what we would suggest. We would suggest tax efficient investments you can do to mitigate that. And as well, I mentioned, so self-invested personal pension schemes or gross salary sacrifice schemes. These are all things that it's better to do now rather than wait until after the tax year. And by that point, there's very limited planning opportunities we can do. So say from 6th of April, you make it your New Year's resolution to join the company pension scheme, or perhaps you want to increase the amount you're contributing, then now's the time to have those conversations so you can make sure that your affairs are in order before the start of the next tax year. Some of you also will have seen corporation taxes on its way up. So again, this is just another sort of tax increase, tax hike for corporations this time, as opposed to individuals. So if you are, say, an entrepreneur and you have a business and you want to, say, maybe make some efficient investments, such as purchase an electric car or some machinery, then come speak to us and we'll be able to hopefully reduce your corporation tax exposure. But the UK in general, the new corporation tax of roughly 25% is going to be more in line with what other countries are doing. So up until now, although it hasn't seemed this way, the UK has had quite a low corporation tax rate when looking at other jurisdictions, particularly major economies such as the US. But of course, that doesn't mean that, just because the corporation tax is 25% on profits, doesn't mean that that's necessarily what you're going to pay based on things such as if you do any capital allowances or tax efficient investments. So I would say now is the time. We've just had, thankfully, the tax year doesn't run in accordance with the calendar year. So maybe over the Christmas period, you were reviewing your finances and you decided that 2023 is going to be the year you start saving for retirement and retire at 65. Then, of course, now is the time to start reaching out to us. Let us know. We advise on property tax structuring, inheritance tax, safeguarding reliefs, making sure you're utilizing all available reliefs of each tax year. Of course, and as my colleague Chris is going to talk about in a minute, financial planning and protecting assets in your bloodline. So I think that's it from me. I'll hand over to my colleague Chris. Chris is a financial advisor here at Fusion. He's a very incredibly experienced and overall a very lovely person. So Chris, over to you.
Oh, thank you, Henry. I appreciate it. That's lovely. Yeah, I'll pay him later. Lovely. So yes, I'm Chris. I'm a financial advisor here at Fusion Financial. This is generally wealth planning, and all of the taxes that or near enough all of the taxes you've seen so far, there's something that can be done about it. So if you're thinking, oh, I pay that tax and it sounds like it's getting worse, reach out. There's possibly something that we can do. Consultations are free. Why not find out? So let's talk about a few things. So obviously, the end of the tax year is coming up, April 5th. So there's a variety of things that you can calculate around this time, and we do these to make sure that you're taking advantage of everything available to you. At the end of the day, wealth planning is about putting money away, so you might as well put money away that benefits you, particularly in tax or particularly in just wealth planning in general. So things like pension funding can get incredibly complex. There's a multitude of things that can go wrong. I've seen them all. There's multiple times I've talked to someone and they have drastically made a mistake in this area, and you end up, in all sorts of a pickle. So talking to someone, just going over it, saying, what can I possibly do? What makes sense? £1, £1 million. That's, there's something that can be done. The ISA allowance. So it's one of the best ways possible that you can invest is by using your ISA allowance. People typically think it's a cash ISA, whereas actually typically you can look at stocks and shares. Capital gains planning. As was said by Henry, it's getting worse. If you've got shares, investments, and you think, oh, I might sell these soon, what might be good to pay off the mortgage with these, something like that, have a chat. Easy to do it now than in a year, 2 years. And obviously setting up for those tax years, knowing what the changes are going to be, are essential. So having those conversations early always helps. So as mentioned, pension contribution. So why would you make a pension contribution? You get income tax relief, particularly those people between £100,000 and £150,000 a year or slightly over. This is your time. The rules are changing, as was said. There are things that can be done. If you're starting to think about the future and retirement, then you should be having consultations with advisors like myself. There's a multitude of things that can be done for your circumstances, but anyone really, high rate, basic rate, not paying tax at all, there's a solution. You can still get income tax relief in some sort of way, so very beneficial. The corporation tax relief afforded if you're doing it through your business. So any employers on listening at the moment, or self-employed business owners, the options available to you are far in excess of what is for personal. So understanding those, talking them through with someone. Every business is different, and your circumstances will be entirely bespoke. So your advice should be, and that's what we do. We bespoke that advice to your circumstances. So please have a chat with us. Inheritance tax relief. This is really, really popular. I can tell now it's popular because everyone's properties are now worth ridiculous amounts of money. You automatically fall into the inheritance tax ban before you've even moved out. and then suddenly all of your assets have this inheritance tax bill, 40% on them. And no one wants to pay 40% tax. Why would you? You've earned this money. They call it the voluntary tax because there are so many things that can be done, including pension contributions. If you're putting money into your pension, that's inheritance tax free. If you start considering these, knowing that your inheritance tax bill might be an issue in the future, then you're ahead of the game. You don't have to talk with tax advisors in 10 years' time because you've done the work. The hard yards have been done gradually. And I mentioned again about the mistakes. I've seen people over-contribute. I had a conversation with someone a couple of months ago. He said, I don't need to worry about pensions because when I feel like I'm about to die, I'll just throw £1 million into it. And I said to him, you just can't do that without having horrific penalties, getting yourself in all sorts of issues. And we ended up setting up a pension for him and start making gradual contributions because at the end of the day, he admitted that he wanted money in a pension when he gets to that age, and why wait? So, yeah, very, very important. And kids. I've just had a daughter myself. She's 9 weeks old. You can contribute to their pensions. I think there's a statistic somewhere that went if you contribute the maximum each year, which is not very much at all. I think it's just over £3,000. If you're contributing the maximum each year into a pension for your child, by the time they retire, they will be a de facto millionaire if they're invested properly. You're making them a millionaire for 18 years of very minimal contributions, and it's inheritance tax free. If you can afford to do it, almost why wouldn't you? Set up a proper one, talk to us, get it done properly. And there's a few nuances that need to be completed properly to make sure it does what it needs to do. It makes total sense. So I spoke about the ISA allowance originally. You get £20,000. And the best thing about it, you can transfer cash ISAs to stocks and shares ISAs. These are the ones that we really want. Everyone should have a little bundle of emergency cash. But most of the time, anything over that, you want to have it invested towards your long-term goals. The ISA allowance and using ISAs, stocks and shares are one of the best ways to do it. Simply because it's a bit more flexible than pension. You can touch it before age 57, which is great, but it's getting a lot of the same tax relief, just not the income tax relief on top. So it's very much, when I speak to a client, most of the time, standard, let's talk about pensions, let's talk about ISAs. And near enough, most people come under those two headings before we have to go look at all the sexy stuff. So very, very worth considering. And opening them, again, there are people who have hundreds of ISAs. Why? Have one good one. It makes sense. And again, the junior ISAs, I mentioned the pensions, it's exactly the same for the ISAs. The only difference here is that they can touch it once they reach a certain age. It's their money. We're talking about first cars, deposit for a house, which we know is so important these days in this day and age. As you're coming up to the end of this tax year, consider, do I have 9k to pass to my child? Do I have 500 quid to pass to my child? Should I set it up in something like this for their future? Probably yes. And that's the sort of thing that you'd look to do. So this graph is almost a little bit fake. I'm going to say it. I mean, everyone wants to think that the blue line is going to be every investment you ever make, and it's just not. Everyone thinks that they can do this themselves. They can't. This is a fund that has done very well, but then you can see recently has done very poorly. And I tell you, that big peak is where the everyday person said, buy, and then the big drop off. So everyone who invested in it lost loads of money. They feel horrible. I tell you, at the peak of that graph, we got well out of it and invested in something more defensive and missed all of that downfall. So experts make the difference. They really, really do. I know a lot of people who fall into the trap of thinking that because something's gone up for 10 years that they're a genius, and it only takes 1 year to correct the algorithm. The amount of time and energy and research and knowledge that has gone into investment experience that we have is paramount to the success. And we have had very good success. We've beaten the market by a very long way over the last year. The relative sector is the black line, so it's sort of like a benchmark, if you like. And red is a standard pension. I bring this up because most people have pensions from previous employers. They get thrown into a bespoke standard fund that does okay, a bit like the red line, and they never get the benefits of all of this growth. So, having a review with a financial advisor who understands what he's looking at can go, yes, this is okay, but it could do better, and putting you into something far superior, making sure that those funds that are inheritance tax free are growing faster than everything else. So you've got a big whack of cash that can be passed to your kids. It will pay an IHT bill. It will do whatever it needs to do. It can just sit there and pass to the grandkids inheritance tax free. You're not avoiding 40%. You're avoiding 40% plus 40% to their grandkids. 40%. It's just exponential. These pensions, they really are. Pension millionaires are a standard thing nowadays. Before they even touch them. Capital gains planning. It was almost covered by Henry. But little things that we talk about are bed and breakfast, so making sure that you're selling, and then if you are reinvesting, doing it in the right way, and you've got to wait a certain amount of time before you buy back. However, most of the time you're selling something that's not in an ISA and wanting to put the money into an ISA so that you never have to tax plan again because it's tax free. Lots of people selling properties at the moment. I think it's going to increase this year, possibly the year after. Lots of property selling going on. So if you're thinking property is not the game I want to be in anymore, it's too expensive, and I can see why, then potentially you're looking at alternatives. And now is probably the time to have that conversation about what they can do. So setting up for the new year. So again, another benefit of you having a business, you can pay for your own life insurance. Even more tax efficient. It means you're not having to pay yourself a load of money, pay a bit of tax on it, and then get the life insurance out. You're adding it onto the business. It's super tax efficient, and you're getting exactly the same thing in a trust to the kids if you write it properly, or to your spouse. It can all be done. So if you've got a life insurance plan out there and it's doing what it needs to do, you've got no health concerns, but you've got your own business, have a chat with us. We can set up the right plan so that you're saving a bunch of tax on it. Potentially make sure it's appropriate. I mean, if you haven't updated it in a while, then there's probably something that needs doing. All our family lives adapt and change. So yeah, making sure that's updated, definitely important for the new year. And regular contributions. I mean, if you talk to us and you say, look, I've got £200 a month free every month, I would say, well, why don't you just set up a monthly contribution rather than coming to us once a year? You might as well get it done before you even start and just have the contribution going in. You can change it, you can reduce it, you can increase it. All of those things are super, super easy. And yeah, we'll probably have an annual review and chat and say, look, your investments are going great, the money's going great. Do you want to do more or less? Yes, no. All those conversations, and then keep the thing ticking over. And then eventually you're worth a very lot of money, an awful lot of money. And that's how wealth is built gradually, very much so. So I've got something about Mitch and tax planning here. Mitch, are you here to take over? Lovely.
Yeah, thanks, Chris. And Henry, great useful information. And thanks everyone for your patience. Appreciate there's a lot of information, a lot of golden nuggets for you to digest, and appreciate you hanging on with us. I'll now finish up the next part of the presentation, talking about some tax planning, letting you know some of the things in practice, what we're dealing with, what our clients are doing, and seeing if any of this applies to you. So we've mentioned corporation tax, the changes that are coming in. And one thing we do, and which I'm always talking about with our business owners, with our entrepreneurs, is aligning your business interests, aligning your business goals. Don't just taking money out of your company and paying hefty amounts of tax on that money if you're going to investing in real estate, onshore, offshore, investing in other types of investments, investing in businesses. There is not much point you extracting dividends and paying the highest rate of tax on those dividends when you want to invest into your own future. So in the right circumstances, for a lot of our clients, we're establishing a formal corporate group structure, which essentially means that, as you know, when you have a business, most likely you own the shares of those business, your business partners, your spouses, whoever. Within a corporate group, what we'd be looking to doing is having your own holding company or a family company, which we'll come on to later, which we always speak about. And that company owns the shares in your trading company. And then that that holding company will then own shares in a number of different entities which you'll set up. So let's say you've got a trading business and you want to invest in real estate. You may set up a real estate company, and a lot of our clients are investing in luxury items at the moment as well. We've got a few entrepreneurs who are invested in watches, so they may set up a real estate company, and there may be a luxury goods company. And then what you can do is, when the shareholdings all align to that of the corporate setup, you can maneuver the profits in your trading company, pay a corporate dividend rather than a personal dividend. A corporate dividend doesn't attract taxation, and then you can invest that dividend into a deposit of a property or something else which you may find useful. So I think one of my tips for the new year resolutions will be aligning your corporate interests, aligning your investment strategies. If you don't need the money to live your life, and you want to use the monies that you earn in your businesses to invest, then looking at some type of sophisticated corporate structure might be a good idea. Another sort of New Year's resolution, something that we've been doing a lot of recently for a number of newer clients who have seen us, is around, they've had their standard accountant for the past 20 years, and the accountant's done a good job at putting together the books, as you would expect, of course, but they haven't had anyone from a tax expertise go through to see if they've missed out on any type of corporate relief, any types of capital allowances, any types of reliefs that they could have utilised. So what we're doing now is a bit of an audit, a bit of a RAG report, looking at prior years, maybe putting through a repayment claim of tax for corporation tax paid, producing a red, amber, green on areas we think they could look at as a business and improve their overall efficiency. So maybe something like that, if you're a business owner, might be a good idea to look at and invest in over the course of this year. I think this year is all going to be about remaining efficient, making your money work harder, saving money when you can, and bringing in an expert team to help you with that will no doubt be of benefit. The other thing that you may want to consider, and I'm certainly not promoting this, but you may want to consider, and it's certainly something that we are assisting on a fairly regular basis, is you may want to look at offshoring. So can you look at, does it make sense commercially for your business to have an offshore element to it? Or indeed, have you got fed up with the UK and you want to set up overseas? There may be benefits such as the weather. There may be benefits, of course, such as saving money and taxation. So having an offshore entity as part of your group might be useful for you, might make commercial sense, obviously, have certain advantages in terms of cost savings around staffing as well. So that's something that you may want to put in a plan to the systems, the processes, the legalities, the tax. But of course, with anything like that, it's important to consider the tax legislation. There is a lot of anti-avoidance in and around HMRC, in particular around corporate tax, where the control and management of the company is being done by. And of course, another area to consider with that type of planning is VAT. Intergenerational tax planning. This we're seeing it more and more now. Some of you may be of an age where you're thinking about retirement, or maybe in retirement. Some of you may be thinking about your parents and what they have, and how that's going to come down into your asset structure, and of course tax planning. One thing that we're seeing more and more is that clients of a certain age are now starting to think about tax planning and inheritance tax planning, which you guys touched upon more so than what they did previously. But I think it's certainly this year could be looking around, and Henry touched upon it. The gifting of assets, not only from an inheritance tax but capital gains tax. When you gift something to someone that's not your spouse or civil partner, unless it qualifies for reliefs, capital gains tax reliefs, then it's going to be subject on the whole to capital gains tax. So it's about looking at the strategies of gifting and seeing how you can be efficient on that side of things, but also philanthropy, charitable giving as well. Charitable giving, coming up with a philanthropy a strategy in terms of not only when you are alive, but also on death as an inheritance tax strategy is something that can be considered. Of course, gifting to charity has significant tax benefits, and what we're seeing more of now is clients looking to set up their foundations, whereby you can use a company that sets up a foundation. The donations into that company can qualify for gift aid, and then that foundation can then give to chosen charities of choice. And one of the things we speak to our clients about is, not only on death, you may decide to give, I don't know, £10,000 to charity, or you see clients, are very generous, they give millions to charity, but they don't get to see the benefits of where their money is going, because obviously they've passed away. So we want to encourage our clients in the right circumstances to come up with or potentially create a charitable giving situation for their entities as well. Just finishing up the last few slides, the family investment company continue to be popular with clients who research or see videos on social media. It works in certain scenarios. It's good for when you do have fast growth businesses. Your assets are going to grow to shelter the value of today, that the future growth in that entity up to the children's shareholding will sit outside the estate, because the children already own that. When you have parents who have cash, they might have sold their business, or they might be sitting on cash, then the use of a loan to subscribe to the shares will be of significant benefit. So, often clients say, oh, well, I'll just set up an entity and give my kids different classes of shares. But it's really about, utilizing this form of structure to its ultimate benefit, because obviously setting up something like this does cost in terms of professional fees and maintenance. So it's just about understanding that although it can come across simple terminology when we're speaking about these types of things, it doesn't work or suit every client. And this is why people come to us. We write tax advice, as Henry said, we write tax strategies. But certainly, I believe the family investment route and the corporate vehicles, in terms of using your money and family, will continue to be of benefit. And now specifically, we are 12th of January. We have a couple of months before the end of the tax year. So the end of the tax year, obviously coming up on the 5th of April, 2023. So we have about 2 months to look at your circumstances, any type of structuring to consider that, and to see if you can, make changes today ahead of the new tax year, which will start in April. And of course, in between that time, we may have another type of announcement from our government. So yes, certainly, if you would like to take advantage of our consultation, myself, Henry, and or Chris will spend 20 minutes with you discussing your matters, answering your questions, and seeing how and if we can help you. So please do feel free to reach out. We will be also running a corporate webinar towards the end of the month as well. So look out for our marketing on that. But of course, now dead on 1:45, I will ask you if you do have any questions. Obviously, I invite my colleagues back. If you do have any questions, please feel free to put them in the chat function, or there is a Q&A box, I believe, as well. So we'll hang around for the next few minutes to answer any questions that you may have, and that would be great to answer a couple of questions. So we'll just wait around for the questions to start flooding in.
Well, no, as in no one's no engagement at all.
There's got to be one question here or there.
No.
I'm itching to answer something about itching. Yeah. Someone tell me they got something crazy like a
me one. I can have a little laugh. Can you tell me?
Multiple sips, this, that. Tell me.
If you have a question or if you want to speak, unfortunately, we can't invite you up to speak because there's a maximum number on this platform. But if you do have a question, then please just type it in the chat function, and we'll get to that.
Yeah, or if you want to speak to us, email one of us and book a consultation. Happy to grab 15-20 minutes, like Mitch says, and we can talk it out, go through everything. Near enough, these consultations are really bespoke. I mean, you come to us, tell us that this is my circumstances, this is what I'm trying to achieve. Is there anything, at least tax, financial planning wise, that I can do to improve my situation? Whether that be property, whether that be pensions, whether that just be in general. It could be just general life planning and sorting out circumstances. So yeah, I highly recommend. All the emails on the screen. The best one is me. You're happy to reach out to me, and we can catch up. Yeah, I don't bite. You can come to the office too, see that we're real people. We do have a lovely team here. So yeah, would be good to see you.
And the other thing just to note, as always, I think it'd be remiss of us just to mention the fact that the self-assessment deadline is coming up on the 31st of January. That's for tax returns that are due for the tax year ending the 5th of April 2022. Make sure you submit those if you do have a requirement to do so online by the 31st of January, or you will get an automatic penalty of £100. So we're quite busy helping our clients with those in the tax division, to say the least. But yeah, next time we speak to you, it'll be in February. So, all right. So, thanks for all the questions. We'll be back. So, as we said, what we're doing now is at Fusion, we're having one private client webinar per month and one corporate webinar. So, our corporate webinar will be towards the end of this month, and that will be on research and development tax relief. The new announcements around that, qualification around that. It's tremendous relief available, 130% corporation tax relief. So if you're interested in that, make sure you're looking at our marketing and social media. So I'd like to thank Henry and Chris for your time and wisdom. I'd like to thank you all for investing the time this afternoon to spend with us, and we'll see you at the next webinar.
Pleasure, guys. Thank you. Take care.
Thank you, everyone. Thanks.
Bye.